Hello there, my people. Welcome back to Sheila's World. I'm so happy to have you back. And today we are back with a new topic. I hope you enjoyed my last video. If you haven't watched, go back and watch my video on 52 weeks of saving. I said this year we are going to grow. Don't be left behind. And we are going to share all the information that is there which can help you grow. So if you haven't subscribed, subscribe and please like this video. Today's topic is about, people have been asking me about difference between treasury bills and bonds, and also is it the same as money market funds. So today we're just going to do discussion on how different are they from each other and which one do you think you can invest in. So get your pen and paper and have a glass of water, sit back and let's see which one do you think you can go for. I already said everyone should open 52 weeks of saving and money market funds, but for those who wants to know about bonds, do you have any idea what bonds are or treasury bills? I know you've come across them, but not everyone knows what it is. So I'm just going to brief you on summary of each one of them, and maybe you can make a decision. We need a diversified portfolio. We don't need to just think of money market funds only. There are various ways of investing, and that's why we are here on this channel, to help each other grow. So give the video a like and I'll be back in a minute. I hope you've liked the video. Let's get down straight to the point. I know if you've never invested in treasury bonds, maybe it's because you think it's reserved for the rich, and you are wrong. Anyone can invest in a treasury bond, and I don't know if you understand what are treasury bonds. If you don't, you should be a friend of the Central Bank of Kenya website. There's so much information when it comes to bonds, and these are simply government securities which are risk-free. You are able to loan the government, and the government promised to pay you a certain rate of return, which is always higher than money market funds rate. Most of the time, the government offers about 15% return. And for those who've invested in money market funds, I think you know the average is usually between 13 to 14%. It's hard for you to go beyond there. So government securities, which are the treasury bonds and bills, sometimes are better options compared to money market funds. But again, I'm just going to give you the reason why maybe majority of you might not be in a position to invest in bonds, and money market is what can work for them. With government securities, you are guaranteed. This is a guaranteed investment, which can ensure that you have that consistent income, since the coupons are paid every 6 months. So it's just in simple language, it's like you loan the government money. Every now and then, the government always comes up with it comes to the public to borrow. For example, an infrastructure bond. You've seen roads being constructed, and that's when they come to the public. They float a bond, like we need 50 billion to do a project, and we are going to return this money with this interest rate. So it's a guaranteed return. Sometimes it can go even 17, 18%. And that one you are assured you are going to get. So the only downside of it is the minimum. You need at least 50,000 for you to invest in treasury bonds, and 100,000 if you want to invest in the treasury bills. So the minimum amount maybe might lock out some of you, or maybe the low income earners, and that's where maybe money market can work for them when they still want to invest in the same, but with low income. So with the bonds, the advantage, as I said, is it has high interest rates. It's almost guaranteed. I've never seen any government defaulting, or I've never seen our government defaulting any bond, even though we've had issues with other countries, like I think I've heard of Ghana, but those are rare cases. So to me, I still find it very safe to invest in treasury bills and bonds. So for you, how to invest, it's simple. You just need to visit the website, the CBK website, and find out which are the upcoming bonds. Then there are steps on what you need to know before investing in bonds. I already made a video on that, so I won't really repeat myself about how to invest in bonds, because if you check my videos, I have such a video. So today is just a way of comparing between bills, bonds, and money markets. Which one would you go for? So you can actually have a diversified portfolio. You are not tied to one. So depending on where you are in your financial journey, some people have enough money, they can have a bond, they can invest in bonds and also still invest in money markets. And what you need to understand is that with the treasury bonds, these are medium to long-term investments. So it's not something when you want money within a year to put your money there, unless you're looking into having the coupons, the interest that is paid every 6 months. But if it's the whole amount of money and you need it within a year, it's not the best place to invest. That's when money markets now come in, because money markets, those are short-term investments which you can invest between 0 to 1 year. But if it's something above 3 years, which are bonds usually are beyond that period. If you are intending to invest long term, then bonds are the best places to invest. With T-bills, the difference between T-bills and T-bonds, the treasury bills and treasury bonds, that the treasury bills are usually short-term government securities. There is a 91-day bill, 182-day bill, and also 364. So depending on which one you buy, you'll pay the price, the face value price. So you buy the bill at a discount. You don't pay full amount. If you're investing 100,000 and the interest is 10%, you buy a bill of, let's say, 91 days, you pay 90,000. Then after 3 months, they give you back your 100,000. So you bought it at a discount. Same with 182, then 364. So you select based on how long do you want the money to stay there. So for short-term investments, treasury bills can work for you. And now the only downside of treasury bonds is that, as I said, if you are looking into short-term saving, it's not the best place. Two, it is the fact that you can't reinvest. Like there's no compounding effect when it comes to your interest rate. So you need to get the interest, the coupon that is paid. Maybe you deposit in your money market account so that you continue reinvesting it for you to enjoy the compound interest factor. So I think if you didn't know, when you're investing in bonds, unless you were buying again the bond, your interest just remains the way it was. So to me, I find you need to know when you paid the coupon, what are you going to reinvest again? But don't think it will automatically reinvest itself. It doesn't reinvest back. So the interest you're given is just fixed on the capital you gave. So they just pay you the interest. There's nothing like compound effect on the interest. So a good advice would be, when you are paid the interest rates, open a money market account. If you don't have one, then deposit the interest there so that it continue earning the interest in the money market fund. And in the money market fund, there's that compounding effect. So your money keeps growing. So I think, especially if people have been investing for a while, I would advise, if you can have both. You can invest in bonds. If you have 50,000 and above, you can look for a bond that is an upcoming bond. Then go to the website, CBK website, apply, and you might be lucky and get it. But what you need to understand, that when you apply for bonds, again, it's not guaranteed that you're going to get. So just try. You might get, you might not get, but keep trying, because they keep coming every month. There's always a bond floated every single month. And then for other people who maybe cannot afford the 50,000, you can go for the money markets. So there's something for everyone. Money market is good for anyone, since minimum opening is even 100 shillings. So I think even the low income earners can have a money market fund and start saving. So the advantage of money market definitely is the starting capital is low. Anyone can afford that one, I'm sure. And then accessibility of the money, liquidity, you can easily liquidate your money whenever you need it without going at any loss. And then still the interest rates are good. It's above the inflation rate. So the interest rate of money market fund is above, last year, I think most companies offered above 13% on average. So it's still good, as much as it might not be as bonds, but it's still better. And then the fact that compounding effect is now what makes it even more attractive. If you don't take your interest, it keeps compounding. So over time, your money grows. Is there a disadvantage? I think the advantages outweighs disadvantages. Disadvantages, maybe you might not grow your money very well because of that accessibility, that you can withdraw whenever you need it. For you to grow your money, it needs to be locked away like a bond. We tell you, come for it after 7 years. So that accessibility factor again. If you don't have discipline, it's as good as having money in your M-Pesa. in your phone. So have discipline for you to grow with the money market funds. And also the fact that still interest is taxed at 15%. So with the treasury bonds, it's tax free if you are investing above 100,000. So that part of interest applies on money market funds but doesn't apply on bonds. So I think that that information can help you decide which product you think you'd want to invest more this year. But at least let's have a diversified portfolio. We can have all of them if we can, since we are planning to grow. So let's all be millionaires by the end of the year. I think that information will help someone. And if you haven't subscribed, please subscribe and give the video a thumbs up. I'll talk to you again in my next video. Bye bye for now.